Look at the headlines today, and you will see the same story repeated on every major financial network. Nvidia just reported a staggering $81.6 billion in revenue for a single quarter. Wall Street is celebrating. Retail investors are buying. The hype machine is running at maximum capacity. But behind closed doors, something very strange is happening. Some of the most successful investors in the world are quietly hitting the sell button on Nvidia. Billionaire money managers like Stanley Druckenmiller, who rode the artificial intelligence wave from the very beginning, have fully exited their Nvidia positions. They are walking away from the most valuable company on the planet right in the middle of a historic earnings run. Why? Because the smart money knows a fundamental truth about market cycles. The highest returns are never found in the crowded trade. They are found in the infrastructure that the crowded trade relies on to survive. Nvidia is no longer the entire artificial intelligence story. It is simply the engine. And right now, the global economy is realizing that an engine is completely useless if you do not have a transmission, a fuel line, and a cooling system to keep it from tearing itself apart. Welcome to the second wave of the AI trade, the shift from general-purpose training processors to the hidden infrastructure layer. Over the next 10 minutes, we are going to break down the uncomfortable math hiding inside Nvidia's earnings report. We are going to look at 3 specific stocks that are perfectly positioned to capture the billions of dollars flowing out of Nvidia. And we are going to explain exactly how the architecture of the modern internet is being quietly rewritten. To understand what happens next, we have to look closely at what Nvidia's management actually said during their latest earnings call. They didn't just announce a beat on revenue. They introduced a completely new market segmentation. They told us that the era of relying entirely on hyperscalers, the massive cloud providers like Amazon, Google, and Microsoft, is evolving. They introduced the concept of the AI factory. An AI factory is a massive, industrialized data center designed specifically to process machine learning workloads. And building one requires a level of physical and digital coordination that borders on the absurd. Here's the problem. When you buy an Nvidia Blackwell or Rubin GPU, you are buying pure computational power. It is an incredibly fast brain. But a brain operating in a jar cannot do any actual work. It needs a nervous system to communicate with other brains. It needs an underlying architecture to handle basic logic. And it requires an immense, almost terrifying amount of electricity and thermal management just to keep from catching fire. The bottleneck to artificial intelligence is no longer the GPU. Nvidia has solved the compute problem. The new bottlenecks are networking, custom silicon, and power. That brings us to the first stock, poised to capture the next wave of institutional capital, Broadcom. When most people think of Broadcom, they think of legacy telecom and old-school semiconductor components. That is a mistake. Broadcom is the nervous system of the artificial intelligence revolution. As AI models become exponentially larger, they cannot be trained on a single chip. They require tens of thousands of GPUs working together in parallel. But getting 50,000 chips to talk to each other at the exact same time without crashing is a nightmare of physics. The data has to move across optical interconnects and networking switches at the speed of light. Broadcom completely dominates the high-end networking space. If you are building an AI factory, you are almost certainly using Broadcom networking chips to tie your Nvidia GPUs together. But there is a second, even more lucrative side to Broadcom's business: custom silicon. Companies like Google, Meta, and Amazon are tired of paying Nvidia's massive premium for general-purpose chips. They want chips designed specifically for their own internal software. Broadcom is the premier manufacturer of these application-specific integrated circuits. When Google builds its custom tensor processing units, Broadcom is heavily involved. As the AI market matures, we will see a natural shift. The hyperscalers will continue buying Nvidia for bleeding-edge research, but they will aggressively pivot to custom silicon to run their daily consumer applications cheaply. Broadcom profits from both sides of this equation, and to do that, they are relying on the intellectual property of our second stock, ARM Holdings. ARM does not manufacture chips. It writes the fundamental instruction sets, the architectural blueprints that tell a processor how to function. This brings us to our third stock, Vertiv. Vertiv solves the most boring yet most critical problem in the AI transition: thermal management and power infrastructure. They specialize in direct-to-chip liquid cooling. This involves pumping engineered fluids directly over the processors to pull the heat away. Right now, the deployment of Nvidia's newest chips is being delayed in certain regions, not because of software bugs, but because the physical buildings cannot handle the thermal load. The transition from software to heavy physical infrastructure has begun. The smart money has already placed its bets on the underlying systems that make the illusion of infinite compute possible. The only question left is, when the artificial intelligence buildout hits its absolute physical limit, who will be left holding the bag?